In the industry, us financial brokers talk about things such as good debt and bad debt and so forth. Right? Good debt is where we are buying an asset and someone is paying that asset off. So we're not personally paying for that. So for example, a good debt is someone going out to buy an investment property, say for $300,000. They're getting a loan on that for 90% of the property, so $270,000, and then we've got a tenant in the property that's paying rent on that property. Alright, we classify that as good debt because someone else is actually paying your debt back for you. Sometimes it can run a bit negatively geared, alright, but we place buffers and help you in with those loan structures that I talked about previously, like lines of credits and interest-only loans and offset accounts. We make sure that there's buffers in there to help you make sure that you can cover those if there are any losses on those particular houses that you're purchasing. Now, a bad debt in our names is any owner-occupied debt. You know all those credit cards you've got, the good old GE, interest-free cards, the owner-occupied mortgage that most people have and they want to get first. We classify that as a bad debt, all right, because it's non-tax deductible. You don't get any benefit from it, and you've got to earn PAYG money, or money that's taxable, all right, to pay that debt back. So if you're on an income of say 80,000, 30% of that gets taken out in tax. That leaves you with roughly about 55, 60,000 of available cash to pay that house off. All right, so it's a way of where it's actually costing you, and you're not receiving a tax deduction by our Australian laws here. The Australian government, they give us tax deductions for investment debt or investment purchases. If we're going to borrow for and lock it in, and we're looking for a fixed rate or a variable loan, if you're really concerned about rates or changing, then yes, maybe fixing is the way to go. However, if you've got a mentality of an investor and a wealth creating person, 90% of those people will choose variable loans, right? Because it gives more flexibility. If we're selling an investment property, where do we put the profits for that? You know, we want to reduce loans, all right? We want to be able to pay extra into those loans at any time. We want to just be paying interest only on them at any time. So variable gives us the flexibility of where we want to go. Yes, we need to understand there are going to be rate rises. Also, as we might have just seen, we've just had a whole lot of rate decreases. So, you know, it sometimes it has some benefits, sometimes it costs a little bit more. What I advise people is to weigh up what the costs are going to be at an average rate, maybe a couple of % higher, and can you afford that? Alright, so, but most of my clients, or 90% of my clients, go for a variable loan, alright, because it allows for flexibility. Alright, if you're selling properties, you're able to got that cash, and you can dump it back in another loan and reduce debt there on the short term, or pull it back out as investment debt. So, you know, what we want to concentrating on is, again, paying off a little bit of that bad debt, which is your own occupied house, when you sell an investment property, and reducing that, so then you can pull it out as investment good debt. The advantages of using a finance broker are we look after your needs, all right? We're tailoring our needs to you. Every person that we come and see is different, right? But we're here for the long time, all right? We're not changing our role. I own the business, so you'll be seeing me or one of my brokers that are involved in the business. We understand multiple property structures. We also understand entities. A lot of other people out there may not understand buying in a trust, buying in a company, buying a commercial property, buying a residential property. What are the pros and cons against building versus buying an established, doing a reno, all right? All these different types of things, strata titling, development deals where you might be doing a 4-pack or a 6-pack, or even something much larger. We're here to help you and to guide you into the right product for your needs. By coming to a broker, we have multiple different lenders with multiple different products. Now, each lender services at a different level, and that gives different maximum borrowing potentials off a different lender. So you might come to me and your bank only said that you could afford to borrow 300,000. You might come and see me and look, we can get it up to 400,000 for your borrowing capacity. Now, that's a huge jump in prices if you're purchasing property, or the ability, instead of maybe buying one property, you could be buying two properties. Imagine what you could do if you're buying two properties and the wealth that you can make by holding onto those assets for a long-term strategy.